Hi all and welcome to the Henwood Edge. I'm Chris Henwood with North Point Bank, and this week we're going to talk about why it's better to own your home than rent it. Now there might be a lot of people out there renting in the marketplace currently, or maybe they went from being a renter to being a recent homeowner. I think you're going to find a lot of the information in this episode really relevant and really helpful to you. So let's get started. If you're paying rent, you're still paying a mortgage. How can that be, you say? I'm paying rent, not paying a mortgage. The difference is you're just not paying your own mortgage. You're paying somebody else's. You're paying for their mortgage, you're paying for the utilities, you're paying for putting money in their pocket and helping their property appreciate over time, not yours. Big difference. Okay, now I'm a data junkie. I follow lots of different market indicators and a lot of different indices that are out there. One of the biggies that just came out recently is the Consumer Price Index, also known as the CPI. What is the CPI? CPI is, give you a definition here, measure of the average change over time in the prices paid by urban consumers for a market basket of consumers' goods and services, such as we got food, shelter, fuel, utilities, energy, clothing, education, medical care, and several others. You can find all of these on the government website that's listed later. Okay, the latest CPI report showed an annual increase in rent from 3.4% to 3.6%. 0.2% doesn't sound like a lot, right? Well, let's take a look at the bigger picture. Here we have a chart showing this exact CPI number, just the rent portion of it, going back to 2007. Now, you can see up here, we've been in a rising, since 2010, we've been in a rising year-over-year rent increase environment. And now that 3.6% is just pushing that curve even higher. That doesn't bode well for renters. Now, let's just jump right in with our example. $350,000 house. If you're going to rent this house on a monthly basis, it's going to cost you $1,864. Now these numbers are based on North Jersey, but it's all going to be comparable and kind of scalable to whatever your region is. Now the monthly cost to own that same home, $2,581 per month in the first year. Now, there's going to be a lot of data on this, and this will be included at the end. I subscribe to MBS Highway. MBS Highway is a great source for data and for other tools to help my clients make intelligent decisions, and that I can share with them a lot of these kinds of examples so that they can help increase their own personal situation. So here you have in this column, might be hard to see on the video, but like I said, I'll attach it, what it looks like your cost to buy in the first year, and what it looks like costing to rent in your first year, and then at year 9, what your cost to rent is. And if you look at the chart, the cost to buy stays pretty steady because the mortgage is a fixed one that we use in the example, and you see rents are starting to approach and that gap is closing. But the kicker is the cash flow difference is just under $54,000, which means that you will have a cash flow improvement if you rent over those same 9 years of just under $54,000. Now you say, wait a second, how is that supposed to help me go from being a renter to a buyer with that example? That's only part of the story. The rest of the story is contained in these next few slides. Your property is going to appreciate over time. In our example, using a conservative number for Northern New Jersey property price appreciation over 9 years, you're going to pick up $187,000 and change in appreciation value. In addition, amortization wise, you're going to pick up another just over $55,000. What is amortization gain? That's when you pay your mortgage each month and you have your principal and you have your interest. As you're paying your principal, that's increasing your amortization gain. That's value you're putting into your own property. So you're picking up those two numbers, and when we net out that cash flow loss as a homeowner, you're going to pick up as a homeowner just under $150,000 in value. Now, that sounds like a much better deal. Here's a way to kind of look at it a little bit different. First year, you have your closing costs a little bit negative. Every year thereafter, you're picking up value between amortization and appreciation, and this is netting out that cash flow differential that you saw on the earlier slide. Again, at year 9, we're looking at just under $150,000. I don't know about you, but I think picking up $150,000 in 9 years of value beats the pants off of the $54,000 cash flow differential. And that's net that. So recurring theme through all my videos is that people will tell you there's a one-size-fits-all solution for whoever your client may be or whatever you are. I do not subscribe to that theory, as we all know. There's no such thing as a one-size-fits-all. Please give me a call. You can text me, email me, call me on the phone, and we can talk about your personal situation. Let's get you from being a renter into a homeowner sooner rather than later before those rents keep going up. That's all for today. Thanks for watching the Henwood Edge. I'm Chris Henwood. We'll see you next week.
This is not a commitment to lend. All loans are subject to credit review and approval. Not all loan programs are available in all states. Contact a North Point Bank loan officer for further details.